Welcome back to our live coverage of the World Economic Forum here in Davos, Switzerland, where nightfall is beginning to fall upon the Swiss Alps.
Yes,
right?
Nice.
Beautiful,
I like the
beautiful
way you put
night
that.
here. We want to welcome to the show Carlyle's co-CEO, Glenn Youngkin. Glenn, great to have you here.
Thank you so much for having me.
You had a busy day. It started early with a President Trump breakfast, I understand.
Well, I think it's been a busy day for a lot of people.
It has been.
Morning.
It has been. Tell us about the breakfast and what was sort of the big takeaway for you?
Well, I think that the big theme from the president's entire visit here has been, I think, the success of the U.S. economy. And I think the recent trade announcement is another step towards underpinning that success. But I think across the board, the U.S. economy has performed well this year, I think better than a lot of people had expected. As a result, the markets have been up. And I think there's a fair amount of momentum. And I think the president wanted to make sure everybody fully understood that.
Yeah, right. And there is a little bit of a disconnect because when you talk to your European friends, they're maybe a little bit less sanguine just because, they just don't have the growth here, right, Glenn? And yeah. I'm wondering if, we've got this America on an island, Fortress America situation we talk about from time to time where really the growth in the developed world is almost 100% there. Is that kind of the case?
Well, I think there's been a big shift over the last 10 years, which was different than what people expected. So if we'd been sitting here 10 years ago, and we had taken a 3-person poll on whether we thought the U.S. was going to be a larger part or a smaller part of global GDP in 10 years, we would probably have voted slightly smaller given the growth in emerging markets. And guess what? We were wrong. And the U.S. is a larger part of global GDP today than it was 10 years ago. 25% today versus 23% 10 years ago. That just represents 10 years of pretty sustained growth versus ups and downs in other parts of the world. But I do think the opportunity for everyone does reside in the cooling of trade tensions. And I don't think anyone believes that this phase 1 deal is the end of trade discussions, but it does signal a constructive tone. And there's been one factor over the course of the last 2 years, which has really been the core cause of the slowing of growth around the world, and that has been trade. And so I think if there's a more constructive tone to trade, and we can in fact see a pickup in trade around the world, then we should see an increasing growth relative to the slow growth in the economy that most people expect. So I think there's some upside as long as we can keep a constructive tone on trade.
At Carlyle, you have over $220 billion in assets. You're sitting on billions to invest. Given that there is more clarity on sort of the global stage right now, where are you seeing the best opportunities? Well,
one of the challenges that comes with slow growth and low interest rates is high valuations. And in almost every asset class, valuations are in fact high. I think the one area is energy, that it could be viewed as an opportunity for value today. But otherwise, everything around the world is expensive. And so what that requires is a lot less of we're just going to go buy everything and a lot more of we're going to be quite selective in what we do. And I think that's where Carlyle's at its best. We have great industry teams, and those industry teams focus on specific companies or specific projects. And that enables us to bring all of our capabilities to bear to try to take a good company and make it great, or a good project and make it better. And that's where we're going to have to get our returns over the course of the next 3 or 4 years. Asset prices are high. We expect them to stay high, but that just requires you to add a lot more value than historically.
Hey, Glenn, as the CEO or co-CEO of a private equity company, you have a portfolio of companies, and some of them have a higher profile and a lower profile, and sometimes you have to take some heat. But the Taylor Swift thing is kind of a whole nother level. And I want to see if you could give us an update on that situation. Taylor Swift asked Carlyle to intervene in a dispute with Ithaca, which owns her music rights and receives investment from Carlyle. And so you get Taylor Swift on line one.
Right?
That kind of thing.
Well, first, I think we all really appreciate just what a spectacular artist Taylor Swift is. To disappoint you, I can't give you an update. But I do think that it does represent, I think, a focus that private equity is getting today. And I think that focus is a result of the fact that we haven't done a great job of helping everybody understand really what we do and the full nature of the economic contribution that we make. And I think that's one of the things our industry needs to do better.
In fact, some people paint you as villains in terms of job destruction and tax loopholes and those kinds of things, right?
You're vilified, really. Alexandria Ocasio-Cortez was one of them recently who said something about that. So what would your message be to them?
Yeah, well, I think the good thing is there's a number of folks who actually quite appreciate what we do. And so I think what we need to do is more comprehensively help people understand that. I think first and foremost, the industry is a large industry, and we do make a substantial economic contribution. We make a contribution to the investors. So, I mean, we're highly regarded participant in asset allocation to pension plans around the world. And in fact, I think we've routinely been described as the best performing asset class. And many CIOs for some of the largest pension plans, in fact, have said publicly, we need more private capital, more private equity, because the returns that they generate are critical for us to fulfill our own obligations to our own beneficiaries. So that's basket number one, and we're hoping people can understand that. But I think more importantly is what do we do from an economic contribution standpoint? And again, I think we're not perfect as an industry. There are always going to be challenges along the way, but we invest in companies to make them better, not to hurt them. We invest in projects to make them better, not to hurt them. And as a result, the job creation, the economic contribution, and in fact, the slipstream that comes with it from supply chains and community involvement continues to be an area that when we sit down and educate people as to the order of magnitude of what that economic contribution really is, then they say, oh, well, I actually need more private equity in my district. I need more private equity in what's happening in business growth. And that's just on us to do more of.
Right. You know, yesterday we spoke with John Tuttle of the New York Stock Exchange, and he was talking to us about the healthy pipeline of IPOs they have. On the flip side of that is what you do at Carlyle. Are you finding from clients that, are they saying, hey, look, we actually are considering the public market? Are you seeing that more than you have in the past, say, 2, 3, 5 years? Yeah,
well, I think the reality is over the last 20 years, the number of public companies versus the number of private companies has shifted completely.
Yeah.
Shifted completely. And we've had the lowest number of IPOs over the last couple of years in history, or at least in recent history. And that does reflect, I think, two big trends. One, there's lots of capital to invest in these private companies. And second of all, companies are enjoying being private, and they don't need to go public in order to access capital. In order to meet their growth plans. And so that's a big shift in corporate capitalization today. The public markets are there, and I think there's some wonderful companies that will list and go public, but there's also many, many companies that choose to stay private for a long period of time, and there's substantial capital to support them. And so I think there'll be a healthy tension between public markets and private markets as to where the best source of capital is, and I think that gets back to what I was mentioning earlier, that competition today is more than just do you have money. It's what can you do to support a company or a project in its growth ambitions, and can you help it become better? And that's where our returns come from, but also that's how we, in fact, compete not only against public markets, but compete against our peers.
All right, Glenn Youngkin Carlyle, Co-CEO, great to have you here.
Great, thank you so much for having me.
Thank you.